this. So thanks everybody for tuning into What's Working Wednesday, another edition. And I want to thank Brett for arranging the guests. We have Cliff Taylor and Mike Olden. And so I'm gonna go ahead and turn it over to Brett to make a little introduction of Mike, and then we'll let Mike get rolling.
Awesome, thank you, Doug. Appreciate the platform. Thanks for letting us jump in on your What's Working Wednesday. I know this has been a successful series for you guys ever since since we've had to stay at home. So, our goal is Penrith is we want to just bring value and some good content for the brokers, for your customers, and for other people in your lives. So today I have the pleasure of introducing a gentleman that works with one of our best partners in my business. He's from American Reporting Company, and so they help us manage and put together our credit reports, but they do so much more than that. That's just kind of the tip of the iceberg. There's a lot of things that we rely on American Reporting Company for, but without further ado, let me just bring him up. So we're going to bring in all the way from Seattle, we're going to bring in Mike Olden, who is the Vice President of Sales and Education for American Reporting Company. And Mike, I'm going to just go ahead and turn it over to you. Thanks for being here today. Appreciate it.
Well, you're welcome, and thank you. Let me, before we get started, we'll make sure we get the technology running here.
I have your slide deck too. If that doesn't come up, oh, there we go.
Okay,
gotcha. You're on.
Is that viewable now?
Yes.
Yes.
Okay.
Yep, looking good. We've got your starting slide.
Yep, good to go.
Okay, terrific. Well, good morning, everybody. Thank you for joining me today. I especially appreciate the opportunity from Doug and Brett inviting me to join all of you today. I know Cliff Taylor from Spokane at Penrith is also on the line, and as Brett mentioned, we've had a terrific partnership with Penrith Home Loans going back to 2009, when it was known then as Windermere Mortgage Services. And because of that unique relationship that Penrith Home Loans has with Windermere Real Estate, we consider each of you our clients as well, albeit indirectly. But this is a collaborative industry. We all need each other to succeed. And so that's really the foundation of the success of our partnership with Penrith Home Loans for so many years. And you just have a great resource with people like Brett and Cliff, right down the hallway in your office, being able to get up and talk to them. And they've got internal partners such as their processing and underwriting teams, and external partners such as American Reporting Company. And so really delighted to be here today. And my goal, one of my roles at ARC is helping to develop and deliver educational materials such as we're gonna talk about today. And my goal as when I put on my instructor or teacher coach's hat is to inform, educate, and encourage. And that's a concept I learned from one of my mentors when I was coaching kids soccer over here in Seattle. And then also teaching the player to teach themselves. So we can walk away today with more confidence about the subjects we're going to discuss, so that when we do talk to the home buyer, which is really the point person in all of our transactions, that we feel confident when we're talking to them that we can illustrate and explain these different scenarios that come up, so that they in turn feel confident that they can handle these situations. So we're going to go ahead and we'll get started. Now we have this little disclaimer here. I'm not going to read that, but our respective legal departments ask us to present this. We always do our best to go to definitive sources such as FICO, the credit bureaus, the CFPB, and so forth to get our information. And then also, on occasion, you will see examples of credit reports in the presentation. Those are fictitious. So here's today's environment. We're going to talk for the next several minutes about COVID-19 and credit and its effect on credit and credit scores. So we're going to look at a little bit at today's environment, what's setting the stage. We'll talk briefly about the CARES Act. And then we'll talk about some special credit reporting codes and also the impact on credit. And as Doug mentioned at the top of the hour today, each one of you will receive a link to the slide deck. I'm also going to share with Brett some additional resources that he'll be able to send out to you later today. And these are always written in a manner that they can be used by yourselves, your coworkers, and also your clients, because we're all consumers, so we can all benefit from this information. So these are some questions that we have received over the past 3 months since we've been in this environment, not only from our clients and colleagues like yourselves, agents, but also from borrowers. Does the CARES Act exempt me from making regular payments? If I do receive a forbearance, are my credit scores protected? And what about special codes like natural or declared disaster? What effect are those going to have? And then what happens to my credit following the pandemic? These are all questions that are top of mind for probably each of us as a consumer. So let's jump right into a quick overview of the CARES Act as it relates to the mortgage banking and real estate finance industry. We want to remember consumers must initiate the request for a forbearance. And there are 5 main categories here. Basically, the government-backed loans: Fannie Mae, Freddie Mac, FHA, USDA, and VA. Those are the 5 categories specifically outlined under the CARES Act. Consumers are allowed to apply for initial 6-month, 180 days, and then can renew that. And we've learned, at least anecdotally, that most of these government-backed lenders will give a renewal heads up, say 30 days or 15 days heads up to the consumer. Your forbearance is set to expire. Would you like to renew? And but I always think it's good for the consumer to take on some of that responsibility. Don't assume the system will automatically go down that path. We probably have all learned as consumers that when we make assumptions that things will happen, oftentimes we're disappointed. So I think it's always good for consumers. Get everything in writing up front. All of the details on the servicer's letterhead, including what restrictions may be applied to me post-forbearance. And Brett or Cliff, I'll invite you to join in here. Have you learned from the lender's side, if somebody comes out of forbearance on, especially on the 5 major categories, are there any restrictions to refinances or purchases after exiting forbearance?
My understanding, fortunately, I've not had a client that's been in forbearance that I've had to do a deep dive on. But my understanding, when they originally came out with guidelines from Fannie and Freddie, it was 12 months out of forbearance. But there's been some discussion, and I've not seen anything official come out that they're going to change that to 4 months. So you've got to be out of forbearance. What I've been talking to people about, and none of them have been in forbearance, but when I'm communicating and educating my agents here in the office, it's been, as long as they've been out of forbearance about 4 months, it looks like they're going to be able to reapproach the mortgage concept as a borrower.
Okay, terrific. Thank you. And I think that fourth bullet point there is really good news for consumers that have Fannie Mae, Freddie Mac, or FHA. No lump sum required at the end of forbearance. I recall reading remarks and comments from many consumers early on, especially if they were furloughed or had become unemployed. How am I going to come up with 6 months worth of payments? So that's good on those, but I think the important thing to tie all of this slide together is, as a consumer, if you're a homeowner, and you probably have many clients who not only they're homeowners today, but potentially they'll come back to you. They want to buy a second property, or they're an investor, and so forth. They must make the initial contact with the lender and request this. It's, for all intents and purposes, no questions asked, but I think it's a good idea. Get everything in writing on letterhead as an insurance policy. So here, just a little infographic that we can remind consumers about. Communicate clearly to the lender and early that you need a forbearance, and request everything in writing, and then as best you can, keep making your payments on time until that forbearance is accommodated by the lender. And this is just an additional little cheat sheet for some of the key points of the CARES Act section of government-backed loans in forbearance. And again, non-government-backed loans may have similar options, but check with the lender. I've been on several presentations, whether it's the Mortgage Bankers Association or the American Bankers Association, and while many organizations are encouraging all lenders to adopt similar guidelines put forth under the CARES Act, it's the government-backed loans that are mandated. The others, including other types of creditors, credit card issuers, automobile loan servicers, not specifically pointed out within the CARES Act, but I think always beneficial for the consumer to call and request that same type of accommodation. So just to summarize, the CARES Act governs how lenders must report to the credit bureaus when they have a loan in forbearance. If the account was current at the time of the forbearance being granted, they must continue to report it as current. They can't mark that consumer late each month simply because they're in forbearance. They cannot charge any additional interest or fees or penalties while they are in forbearance. However, if the account was in a delinquent status, let's say the consumer had fallen behind, then they have to keep reporting that status as delinquent until the consumer brings it current. Then they must now begin reporting it as current. So a lot of these guidelines, they're put in place to protect the consumer during this unusual environment that we're in right now. So there's some special reporting codes, and we wanted to talk about this because this comes up a lot. And I'm going to call on Cliff in a moment because this was a scenario he had on one of his credit reports for his clients. Declared disaster. There's actually a code that a creditor can place on an account that says account affected by natural or declared disaster. The most recent time, other than the COVID-19 period, that we saw this was a couple of years ago. As we recall, we had two major hurricanes, one in Texas, one down in Puerto Rico. At the same time, we had massive wildfires in north central California, all the way down to Ventura County area, Malibu area there. A lot of devastation. And many lenders place that statement on accounts because the consumer was affected by those natural disasters. Now, early on in the COVID-19, the current administration announced this was a declared disaster, not natural, but a declared disaster due to the pandemic. And we have seen several creditors put that statement on the consumer's accounts. The good news is that statement does not affect a FICO score, the same as a forbearance or a deferment. Those do not have any effect on the FICO score. They may have an impact on the opinion of an underwriter. So, Cliff, maybe you could share again. I know last month you pulled a credit report on a borrower, and I think it was, can't remember if it was an automobile loan or an installment loan at a credit union that had this statement, and the mortgage investors underwriting department was sort of commingling that statement to be the same as a forbearance, which was really stopping the whole transaction. Is that correct?
Correct. And I mean, if you've got something other than a mortgage with that statement, underwriting typically doesn't care if they're still going to calculate a payment into how you qualify. But there was an initial interpretation that if this verbiage was on a mortgage, that meant that it was in forbearance. And so we had to go through steps to confirm with the borrower and with the creditor, the mortgage company that was stating this or reporting the mortgage, that it truly was not in forbearance, and then continually update through the process of the loan to make sure that that next subsequent mortgage payment was made and they didn't enter forbearance. What we learned, not only from a couple of my borrowers' research and calling their creditors, is there are lenders out there, both consumer debts and mortgage companies, that are automatically putting this on every single trade line because the borrower lived in the state of Washington, and the state of Washington was declared was affected by a declared disaster. So there were a couple of credit unions that were automatically on every account putting this comment or quote, and then there were some. We've since found out that there are some mortgage servicers that are doing the same thing, and they're not doing it across their whole system. They're doing it based off of whether or not that state's considered in a declared disaster, and it just increases the need to confirm that that borrower has made the payment that's due or is coming due before we close on a mortgage.
Perfect. Yeah. Thanks for recounting that, Cliff. And I believe our staff at ARC, we were able to do a supplement for you so that could satisfy the underwriter's need. You know, we were able to verify that mortgage was not in forbearance and put a statement on there. But I think we have seen some universal placing of those on accounts. But they are separate codes, and there's an organization, it's the Consumer Data Industry Association, CDIA, that oversees all the reporting codes that creditors use when they report account information to the credit bureaus. And they've had webinars and put out information. One of the resources I'm going to share with Brett is from the CDIA, and it's very good guidelines for consumers. And you can certainly share this with your database there of how these accounts should be reported. So if they see anything that's amiss, I would encourage them, go back to the creditor, just as they would with any reporting error, and get clarification on that. But if it does show up, the good news is it does not affect the FICO scores.
And just in closing on that piece, what we've found that we've addressed it a number of different ways, from the consumer calling their mortgage company directly and getting something in writing that states that they're not in forbearance. We've also, there's an ARC authorization that can be signed that gives ARC, American Reporting, the ability to confirm and then issue a credit stop. And in some cases, some of those mortgage companies will not respond without doing a conference call. So an ARC customer service person, representative, is actually doing a conference call with the borrower and the mortgage servicer to confirm that it's not in forbearance before it can be released to us.
Exactly. And I think, again, that's part of the partnership we have with Penrith Home Loans, and can benefit the Windermere agents and your home buyers as well. And quick summary on declared disasters. Really only the lender can assess the true impact of COVID-19 for each consumer, but they do have a responsibility to report that information accurately and in a timely manner, just as they would report any piece of information on an account. But I think it's especially important now for that. But it's also equally important for each one of us as a consumer to be aware of that. And here at the end, we're going to show you some additional resources to help you as a consumer, and also your clients as consumers and potential home buyers, to make sure that is happening for them. Here's an example of an ARC credit report, and the first two accounts are mortgages. You see account in forbearance. That's how it's going to show up. And then underneath is a credit card account affected by natural or declared disaster. But you can notice on the right-hand margin under the account status, all three of those show as agreed. So even though they have those designations, the creditor is not allowed to say that it's delinquent or slow or anything else. Because this consumer went into those designations with the account being paid as agreed, the creditor is obligated to continue reporting them as agreed throughout that entire time period. So again, just a quick reminder checklist, and some of this is repetitive, but we feel it's very important to give some quick guidance, not only to all of us as professionals within the industry, but especially to consumers. And many consumers aren't familiar with their credit reports or credit scores until they come to you and Penrith to do a transaction. So as best that we can, again, inform and educate and encourage them ahead of time, that's going to save time in the transaction. It's going to make it a much more enjoyable experience for the home buyer. So probably the item that is most important over the past few months to consumers is what is the true impact on the FICO score. And FICO was kind enough, we've got a great relationship with them and one of their scoring principals, and she was kind enough to send this to me in preparation for today's broadcast. The first section, these are items that will not have a negative effect on a FICO score. These following account status. The account's current. It's in deferment. It's in forbearance. Affected by natural or declared disaster or loan modification. Those do not have an effect on the FICO score. So that's good news for all of us. What will likely have an impact? Well, the first two are pretty standard anytime. If the account status is worse, for example, more seriously delinquent than what was reported prior to the disaster, or at any time. So for example, if Brett or Cliff were to pull a credit report today, and 3 months later, the account is past due, or there's a new collection account on the credit report, those are things that are going to affect the score, sometimes dramatically, 50 to 100 points, depending on the situation and the overall file. Also, if you have substantially higher balances on credit card accounts, we've seen that as an indication that scores will typically be lower. And we might ask, well, why are credit card accounts so critical? If I'm making the payment on time each month, what does it matter if the balance is maxed out or if the balance is at 10%? The reason is those are unsecured debts, and a FICO score is measuring risk into the future at the time the credit report is pulled. So when Brad or Cliff were to pull a credit report and the consumer has high credit card balances, large amounts of unsecured debt, that's immediately viewed as a higher risk. Even if the payments have been made on time, the entire history of the account, that's a higher risk than somebody with low credit card balances, low amounts of unsecured debt. Because if we default on a home or a car, a boat, there's some recourse for the lender to go and take that property. But on a credit card, typically we don't have that same ability unless we go through a collection or a garnishment process, which is timely, it's expensive. So that's one thing that we can do when we're talking to potential home buyers. And I participate in a lot of home buyer classes, and one of the things we always leave them is when you're preparing to become a home buyer, there's a couple of things you can do. Number one, if you have high credit card balances, pay those down as much as you can and as quickly as you can. That will optimize your score. If you have any accounts that are currently past due, you want to bring those current. If you have collections or charged off accounts, talk to the lender first. Sometimes those don't need to be paid prior to closing. And you could use that money maybe for an additional down payment or something else in the loan transaction. And then finally, if you have any frozen or locked accounts, lift those freezes, unlock those accounts before you see the lender. Because if the lender pulls the credit report and the files are frozen or locked for security, and many consumers are doing that today, then they can't see the full credit report. That can cause delays. Finally here, paying under partial payment agreement. That does affect the FICO score. How much will depend on the overall file, but for example, somebody has a $1,500 a month mortgage payment and they're on furlough and they work out a deal with the lender. It's not a forbearance, it's not a deferment, it's a partial payment, and they agree to pay $1,000 a month instead of $1,500. Now they're not living up to the original terms of the contract, and when the creditor reports making partial payment, that's going to affect the FICO score. So again, great opportunity to use the resources that you have with the Penrith mortgage consultant right in your office to get direction on some of those types of items. So we'll finish up here with some additional resources. Yours truly went through unemployment fraud last month, and just like Washington State was the ground zero of COVID-19 in this country, we've also become ground zero for unemployment fraud. And about a month ago, the president of our company called me and said, "Hey, Mike, if you were really unhappy with working at ARC, you didn't have to file unemployment. You could have just come in and talked to me." And I said, "Well, what are you talking about?" And he emailed me a copy of the notice from the state of Washington Employment Security Department that I had filed. Now, it wasn't under Michael, it was under Mike, but it was still my Social Security number. Fortunately, ARC caught it right away. I was able to go in and get that taken care of, but there are some good guidelines here that I've learned that I wanted to share from you. And I know Penrith has a great set of guidelines as well. Go to the Employment Security Department, register your name, your social, and your primary personal email address with them. That will stop almost all of the potential fraud. We can also go to the Social Security Administration and register our Social Security number. One of the other common types of fraud is false IRS tax return claims. One of my coworkers and her husband went through that 2 years ago. We can avoid that by registering our Social Security numbers. Now, related but not specifically included is putting a freeze or a lock on our file. Many consumers have done this now. A freeze is always free. A lock is free at TransUnion and Equifax. There's a monthly fee at Experian, but whether it's a freeze or a lock, it reaches the same point to protect our file from unauthorized viewing by third parties. But we do want to remember, if we have a freeze, that freeze takes up to 72 hours to be lifted. So if you're working with a home buyer, and especially in an environment where there's limited inventory and potential of multiple offers, we want to make sure that they lift that freeze before Penrith Home Loans pulls the credit report. That way there's no delays in the transaction, just keep moving forward. Also review our credit report. Annualcreditreport.com is the official free site. It's been around for several years, but 2 months ago, they now amended that so we can go in and view our credit reports weekly. And I've done that each week since this unemployment fraud for me came up. It's easy to do, and you can get through all 3 bureaus in about 10 minutes. You can print them out if you want to, or just go in and view it. It does not come with credit scores. You have to purchase those separately, but I think what's most important for consumers is if they feel they may have been a victim of identity theft, or they have been, what's most important is going in, viewing the report, reacting appropriately. You can file disputes right online, so it's really a terrific resource. And then again, I'm going to send additional resources to Brett today to distribute to each one of you. We want to encourage consumers, especially in this environment. We've seen a lot of credit repair and debt management scams rear up over the past 3 months. We want to encourage consumers, stay away from those. Come to you as their professional colleagues or their business partners such as ARC. But if they really need counseling, true counseling, best to go to HUD's website, find a HUD-approved counselor. And we're fortunate here in the Pacific Northwest. There's a number of really good HUD-certified nonprofit counseling agencies. Here are some other resources here for you. When you pull this presentation up in this format, you'll be able to click right on these links. There's a great overview of the CARES Act and forbearance websites from FICO and Vantage. Vantage is the other major credit scoring model in existence, but we want to remember in the mortgage industry, we use FICO scores. And then also, again, a link to the HUD Housing Counselors List. So I'd like to thank all of you for joining me today. I especially appreciate Doug and Brett inviting me and giving me the opportunity to talk to each of you. And just to remind everybody, again, you've got a great resource with people like Brett and Cliff right in your own office, and business partners such as ARC. I think the real value of organizations like Penrith Home Loans and American Reporting Company is twofold. Number one is the staff, where you've got a lot of experienced people in the industry for many years, at those companies for many years. Our staff averages over 20 years in the business and over 12 years at ARC. And also the time. Transactions now, we know consumers want to get everything done quickly. You know, having great business partners saves time. And you know, one other item that shows up on our credit reports that really helps Penrith Home Loans is a liens and judgment report. You may recall a few years ago, the bureaus stopped reporting liens and judgments on credit reports, and that was because of an agreement between several states' attorneys general and the bureaus. So how do we know if they have that information early on? We deliver that to Penrith right when they pull the credit report, and that can save a lot of time if there is a lien or a judgment on there. So, you know, I'm happy to take any questions, but again, thank you very much. I'll stay on as long as you'd like, Doug, and answer any questions that may have come through the chat box.
Well, yeah, so we have, you know, with Brett here and Cliff Taylor on from Spokane, we've pulled everybody in from around. So, and does anybody have any questions while these gentlemen are on about the information that was covered? And if you do, remember to unmute yourself so we can hear you, because I muted everybody to take away any distractions. So anybody have questions directly now following the broadcast? If you're thinking of one, note the resource. You can always email Brett, of course, and he'll get you the answers. We'll also send out to you, as Mike said, Brett and I will make sure that you get all those links. I know I for one, am going to log on and register my social security number. I'm going to log on to the state site, some of those things just to protect myself. And I think that's a great resource sheet to send out to your clients as well. Not seeing any questions.
Hey, Doug, I have a question.
Yeah, go ahead, Brett.
We have an expert on. This is a little bit different than what we was discussed today, but I've had a couple of brokers ask me, and maybe you can come up with a layman's answer. A lot of borrowers use little apps like Credit Karma, etc. So they tell you what their credit score is based on what these companies are telling them. Oftentimes they get a little bit of a surprise when we pull their credit. I was wondering if you could just speak for a moment about maybe the difference between the little apps that are the free apps that people are using versus when they actually get their credit pulled, just so we can kind of speak to them intelligently about why they think they have an 800 credit score, but it comes back at you know, something lower, for example.
Sure, and you know, when I send my resources to Brett, and Cliff, I will include an article that we wrote for MGIC's blog last year. The primary differences between FICO scores and Vantage scores. And I mentioned a moment ago, Vantage is the other major credit score model in use today. It is about 12 years old, so not as old as FICO scores, but it is owned collectively by the three major credit bureaus, TransUnion, Equifax, and Experian. So for all intents and purposes, it's a competitor to FICO scores, but not in our industry. In the real estate and mortgage finance industry, we still use FICO scores, but those sites like Credit Karma, like annualcreditreport.com, oftentimes they are delivering a Vantage score. And while many of the factors are the same, and the latest version of Vantage scores also use that familiar 300 on the low end, 850 on the high end score range, they are different organizations, they are different scores. So if you're talking with a potential home buyer who says, hey, gosh, my score is this on my personal credit report, I just saw it, and then Brett or Cliff pull the credit report and all of a sudden it's 60 points lower, they didn't do anything to the score. The two major reasons we see differences are the timing and also the difference in credit score models. So I'll send that as well, and I think that'll be a very helpful overview to help everybody understand some of those common differences that we all face when we get those questions from home buyers.
And let me add, Mike, to elaborate, isn't it the FH? It's the Fannie, Freddie, and federal regulators that require that we utilize the algorithms associated with the FICO model and not the Vantage model, correct?
That's correct. So FHFA.
That's what I was trying to say.
Yeah, that's always a mouthful for me too, Cliff. They oversee Fannie Mae and Freddie Mac in their conservatorship right now. And historically, we've only had FICO scores. And one of Vantage's goals was to break into that market. Now, about last November, December, Mr. Calabria at FHFA said, okay, we're going to start the process of looking at alternate credit scoring models. But there's some pretty strict processes in place. So there would have to be at least a minimum of 180 days review and testing and piloting and so forth before they even have the opportunity. So that's on the table there, and we'll just have to wait and see. Even the FICO scores we use in our industry today are not the most recent versions. If you were to go apply for a credit card or an automobile loan, most of the time you're seeing FICO version 8 or 9 being used. We're using still older versions of FICO scores in the mortgage industry because that's really what Fannie and Freddie have authorized to date. It's still the same base FICO score, but it's not the most recent version of FICO scores.
And some of the most recent versions would influence things like what we see advertised, Experian Boost and things like that, where they're pulling in utility company ratings and things like that, correct?
That's correct. Also, there was some updates on collections, specifically medical collections and collections that were paid and the value was under $100. Those are being ignored now in those newer versions. So, but still are affecting the older versions that we use in the mortgage industry. So I think either way, the future for consumers when we get to these newer versions, or perhaps even a completely different score model, could certainly be beneficial to all of us as consumers. And in our industry, when we have better scores, we're awarded with lower interest rates, and a lower interest rate for you as agents means that you have greater options, and that means your buyers have greater options. They can buy, more home, different neighborhoods, different school district, more amenities, and so forth. So there's certainly a downstream effect of managing our credit well, managing our credit scores well. So again, I'll encourage you, use Brett and Cliff as your resource there, and they in turn have a business partner like ARC. We're all in it together to collaborate to ensure that not only do we have successful home buyers, but successful home ownership, which is, I think, always results in repeat and referral business, and that's the best business to have.
That's great. That's actually a great wrap up, Mike. And we'll make sure if anybody did think of a question, make sure you direct it to Brett. Some of you communicate with Cliff, and we'll have to get Cliff back out to Walla Walla again soon when we all are meeting together in person. But this was great to spend some time on Zoom. Thanks again so much, Mike. Next time we'll have to have you come to Walla Walla and have some of our good wine. But thanks for
I would be delighted.
Seattle.
Yeah, thank you so much. Have a great day.
All right. Thank you, everybody.